One of the positions in my portfolio that I have seen tremendous growth from is Caterpillar, stock ticker CAT, and it's currently trading at $236.30 per share. Now, when I originally bought this stock, it was trading a little under $180 per share, and we can see as of right now, I'm currently up around 34% on this position. Now, keep in mind, within just the past month alone, this company has declined in share price quite a bit, around 11.23%, and earlier this year, it was trading as high as $293.88 a share. So earlier I was up around 60 to 70% on this position. Now the company did recently release their latest quarter's earnings report, and there was a lot to be excited about. Caterpillar beat on their top and bottom lines. They saw 12% year-over-year revenue growth and beat expectations by $240 million, and they also beat their earnings per share expectations, releasing $5.52, which was a beat by around 73 cents. So a very nice earnings report. Now, despite the good numbers from the earnings report, we can see it didn't exactly jump the share price up. And what's the reason behind this? Well, if we dig into it a little bit more, we can see Caterpillar did see a decent monthly decline in October, and while the earnings report was solid, it did show another buildup in dealer inventories, while growth in orders and backlogs was weaker than expected. And so if we dig into this concern a little bit more, I'll go ahead and scroll down into the Seeking Alpha article. We can see investors are starting to be concerned about softening future demand, with customers adjusting their wallets amid high interest rates, sticky inflation, and geopolitical instability. So Caterpillar is obviously a company that is heavily impacted by macroeconomic affairs. Over the past decade, the economy has been solid, and as a result of that, we can see Caterpillar's share price has gone up by quite a bit, reaching as high as around $293 per share just a few months ago. So while I currently think the company is in a strong financial position, especially when you consider the financial statements, the big question we have to wonder about Caterpillar is, what is the economy going to look like over the next decade, and is the demand going to stay in place, or will it decline due to things like inflation and current interest rates? Now, historically speaking, we can see the company does have a solid history of paying out solid dividends. They currently have a starting dividend yield of 2.16%, and if we jump over to that dividend history tab, we can see they now have 30 consecutive years of dividend increases, making them a dividend aristocrat. 10 years ago, they were paying out around 52 cents per share every single quarter, and currently they're paying out $1.30 every single quarter, and you can see that was a recent dividend hike up from $1.20. So if we jump over to the dividend growth tab, I'll scroll down, we can see the 3, 5, and 10-year dividend growth rates all pretty solid. It's slowed down just a little bit over the past 3 years, but it's still pretty solid at around 7%, and the 5 and 10-year dividend growth rates both sitting at around 8.5%. Keep in mind, the investing research tool I'm currently using is Seeking Alpha, which you can get a 7-day free trial to and $50 off coupon at my link in the description. But moving forward, if we look at the dividend safety tab, I'll scroll down. The most important thing for me when I'm looking at dividend metrics for a company is the cash flow payout ratio. It tells you exactly how much free cash flow a company is using to pay out dividends. And in Caterpillar's case, it looks like they are in a very healthy range, sitting at around 25% for the trailing 12 months and 23% for the forward-looking year. That means around 75% of their free cash flow is left over to do things like buy back shares or reinvest back into the business or pay down debt. And really around that 20, 25 to 30% mark is exactly where I would like to see Caterpillar. So I think from a dividend perspective, this is a very healthy company. There's a lot to like from a dividend perspective. So with the company dropping by 11% over the past month and down quite a bit from its 52-week high, the question we need to answer is Caterpillar trading at a good value? And to answer that question, we'll be jumping into my stock valuation spreadsheet and looking at a few different valuation models for Caterpillar. Like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in Caterpillar CAT and hit enter, and you can see all of this data will automatically load in. Now, we've already touched on the dividend metrics. We can see the moving averages for the 20, 50, and 200 day all down by a decent bit. Analysts currently have a target price of $267.93. Now, this company operates within the industrial sector, and in my opinion, a lot of people don't really have a lot of industrials in their portfolio. So if you're looking for something to diversify your portfolio, this could be a potential option. Institutional ownership currently sitting around 71.7%, and a beta of 1.10, so you should see a little more volatility than that of the market. Now, the first valuation we'll look at is Graham's valuation. You can see the formula he lays out for us to calculate intrinsic value right here. So the first thing we need is our earnings per share, which I think is sitting at a very nice range for Caterpillar. We apply our growth rate projection, which is still somewhat high when you look at analyst predictions, but go ahead and look into that and see if you agree with that growth rate projection. We then multiply that by 4.4 and divide by Y, which is the current yield on AAA corporate bonds. Now, the current yield on AAA corporate bonds currently sitting at 5.5 at the time of this video, which is much higher than it has been historically, which will drive down this valuation by quite a bit. But nonetheless, we can see we still come to an intrinsic value of $279 per share, so a pretty strong valuation when we look at Graham's valuation. Now, the next valuation we'll look at is the discounted cash flow analysis. Basically, what we're doing is we're projecting how much free cash flow the company will produce in the future. So to do that, we look at the company's historical free cash flow, analyst projections, and industry expectations to project a growth rate for the future free cash flows. I ended up going with a growth rate of around 11%, which is pretty close to analyst expectations. We applied that to the future free cash flows and found the present value of those future free cash flows, added those free cash flows together, added the cash and cash equivalents, subtracted out the total debt, and this gives us the company's equity value. We then divide by shares outstanding, and I came to a discounted cash flow price per share of $254.50. Now, the next valuation we'll look at is somewhat simple but extremely effective, and that is the multiples valuation. Basically, all we're doing is we're looking at how the market is valuing companies that are similar in structure using a price to earnings multiple. So you can see our comparable companies right here. We take their stock price, divide by earnings per share to find the price to earnings multiple, take the average PE, multiply it by Caterpillar's earnings per share, and we come to an intrinsic value of $205.76. Now, the last valuation we'll look at is the dividend discount model, and this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see here, I plugged in the quarterly dividend payouts over the past few years, so we can see how much they pay out each year and our year-over-year dividend growth rates. We saw a really solid year here at around 20%. Most recent years around 7.7%, 8.11, and 8.33. So good dividend growth. That's an average growth rate of around 11%. Moving forward, I'm projecting a dividend growth rate of 6.75%, and with a discount rate of 9%, we come to a dividend discount model price per share of $246.71. So when we jump over to the output tab, we can see all four valuations: Graham's at 278, multiples at 205, DCF at 254, and dividend discount model 246.71. Those averaged together give us an intrinsic value of $246.48 per share. Now, the current trading price at the time of this video sitting right at $237. So with a 10% margin of safety, you could see our acceptable buy price sitting at around $221 per share, and a 20% margin of safety sitting at around $197 per share. So when you apply your margin of safety, it's not quite within that acceptable buy range, but it does look like the company may be trading at a slight discount at its current prices. Again, I was fortunate to be able to buy into this company when it's trading at around $180 per share, so I have seen very nice returns since that time period, and if it dropped back down into that range, I would definitely consider adding more, but I'm not currently looking at this company. But there you go, there is a quick analysis on Caterpillar stock. Go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. Like always, if you'd like to be able to join a community of dividend investors and get access to all of my spreadsheets, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.